During bear market, you see almost everyone sweating. Understandable, because it is painful to see our money vanish. A discerning investor knows what stock to buy at which valuation. But then, what if you don't know how to value a stock? And valuation is a super time-consuming process. Given this, I thought I'll make this video to share a super quick valuation technique, and I'll tell you this through a simple 3-step framework with the help of an Excel spreadsheet. First, we will discuss how we can use this technique for a new age company, and then I'll explain how you can use this technique for old school companies. Please remember, this is a quick method to value a company and not an elaborate valuation technique. Let's start. We have intentionally blurred the Excel sheet at this stage because I don't want you to get scared with all the numbers. We'll go through it step by step so that it's less daunting on you. Step number 1 is picking data. And I've picked Lenskart as an example, and you should know that this is not a stock recommendation and it's used only as an example. New age companies have volatile profitability numbers and can be super unpredictable. For example, see the Lenskart's net profitability numbers. They're all over the place. So any valuation basis profitability can be misleading. Given this, getting a quick sense of its valuation basis profitability is ruled out. Therefore, we look at their top line, that's their sales and trend in sales numbers. Broadly speaking, we take the sales number from the current year, assume different growth rate for the sales number. For each assumed growth rate, we will project for the next 10 years, take the 10th year sales number, assign a simple 5x multiple, discount it back to today's terms, compare with market cap, and discount the value and get a sense of how the company is valued today. I understand this may seem confusing, but we'll go through it step by step. In this part of the Excel sheet, I have my initial data. Company name, which is basically Lenskart Solutions, current year, that is 2026, current year sales number, that is 8,647 crores, current market cap of the company, that is 90,979 crores. You can get the sales data and the market cap data pretty easily on Kite. Moving ahead, we have 2 other data points here. One is the valuation multiple, that is 5. Basically, this is the number we will multiply the 10th year sales number with. We also have a discount factor, that is 15%. This is the return we expect from the equity markets. Moving on to the next step, we project the growth trajectory. Now, let's work with the sales growth. Assume the company is growing and will continue to grow at a rate of 15% for the next 10 years. This means the current year sales, that is 8,647 crores, in 2026 will grow to 9,944 crores in 2027. In 2028, 9,944 crores will grow to 11,436 crores, so on and so forth. Growing consistently at 15%, the 10th year sales, that is in the year 2036, Lenskart will have a sales of 34,982 crores. After the 10th year, let's just assume that the growth rate will reduce and the company will transition into a matured, established company. Such companies usually attract about 5 or 6 times multiple on sales. Alright, with these numbers, let's assume that today you want to invest in Lenskart and want to develop a sense of its valuation. Here is what you can do. Take the 10th year sales number and give it a 5x valuation. That will give you a sales-based market cap of 1,74,910 crores. But remember, this is in the future. To make sense of it, you will have to bring it back to today's terms by discounting it. I have used 15% discounting rate here. When you do that, the future market cap basis sales comes down to 43,225 crores. But today's market cap is 90,979 crores. And this leads us to the third step, wherein we do a reality check. Pause here for a second and see what's happening. If you genuinely believe that Lenskart will grow at 15% over the next 10 years, and if you give it a good 5x sales multiple and discount it by 15%, then the market cap should be about 43,000 crores in today's terms. But the market is valuing it at 90,000 crores. What does this mean? This means that the market expects a sales growth rate much higher than 15%. What could that rate be? Is it 20%? Well, if you do the same exercise, the market cap still does not match. It's 60,000 crores versus 90,000 crores, indicating that it is overvalued. What about 25%? At 25%, it is still slightly overvalued. But at 30%, it seems to be undervalued. What this exercise tells us is that if you're buying Lenskart today, then the market's expectation is that Lenskart will grow its sales anywhere between 25 to 30% year on year for the next 10 years. If that makes sense to you, then well, go ahead and dig for more information. Ask yourself, where will the new sales come from? Which are the cities there is more room for growth? Where will the capex money come from? Find out answers to all these questions, and once convinced, go ahead and decide. Otherwise, if you feel 30% is ridiculous, then stay away. At least you have a framework to work with and don't have to be clueless on valuations. Alright, what about companies that have been around for a while? Let's say Maruti, Tata Motors, Tata Steel, TVS, etc. Well, for such companies with established track record, replace the sales number with net profit and develop the valuation basis the earnings. But when you take up earnings, then make sure you also change the earnings multiple to say 15 or 20 times earnings, unlike the 5x multiple we assigned for sales. Also, since these are mature companies, you may also want to reduce your discount rate to 10 or 12%. Otherwise, the framework largely remains the same and you'll still get a sense of valuation. As an example, I have Maruti Suzuki's numbers and I've taken 2026 net profit numbers, that is 14,394 crores. I have a valuation multiple of 15 times and a discount rate of 12%. With these numbers, as you can look at the Excel sheet, I can clearly see that the market is valuing Maruti between 15 to 20% earnings growth, perhaps at 18%. If you think this is reasonable valuation, sure, go ahead and dig further before you decide to invest. But the point here is that, according to me, this is a way better investing technique than shooting in the dark. I hope you found this video useful and I'll see you guys in the next one. By the way, before I end, I would also like to tell you that we have 2 new regional Varsity channels, that's in Hindi and Kannada, where we put out high quality, informative videos in finance. Please do check them out.